making the case to keep steady during times of global turmoil in this week's fastest 4 minutes in finance. Hello, and thanks for joining us. I'm Scott Inman. It's been a week since the first strikes on Iran from U.S. and Israeli forces, and investors have not yet figured out what to make of it. On Monday, the first day of trading since the strikes, the headlines were dire. I woke up reading that the markets were sinking, but the drop was no more significant than on any given day, retreating less than 1%. By Tuesday, more fear set in, and the S&P 500 index was down more than 2% for much of the day, although it reversed course and closed down less than 1%. The market moves are a reminder that global turmoil is not a reason to panic as an investor. The short-term reactions are just that, short-term. It is true that the longer a conflict lasts, the larger impact it could have on the global economy and stock markets. In the current conflict, the biggest economic threat is on oil. The conflict is being carried out close to one of the largest transportation corridors for oil. If those transports are threatened or disrupted, there would be a real-world effect that could drive up prices at the pump. Iran's retaliation has also targeted the oil-producing infrastructure of many countries in the region, adding to fears of what LPL calls perceived supply risk. But history tells us investors will be better off just riding all of this out. Take a look at this chart from LPL Research. It shows more than 24 major geopolitical events since World War II. It includes everything from the Pearl Harbor attack to the Kennedy assassination to 9/11. The average one-day decline of the S&P 500 index was just 1%. And on average, markets tend to absorb shocks quickly, hitting bottom within 18 days. And it takes on average less than 39 days for the S&P to get all the way back to pre-event levels. So it's important to note that the scale of the initial event is not necessarily a predictor of the magnitude of the market impact. Take the September 11th attacks, for example. The fallout from those attacks lasted years, but the S&P 500 reached its bottom in just 11 days and had fully recovered in 31 days. What is a better predictor of the long-term impact that a global shock has on the stock market is whether the economy is close to a recession. According to LPL, if the shock occurs during an expansion, markets are usually positive over the next 3, 6, and 12 months. But if a shock occurs near a recession, and you could argue the event might cause that recession, markets are typically negative across all those same time frames. As LPL puts it, the consistent takeaway is that shocks cause volatility, but rarely change the long-term trajectory of the economy, unless accompanied by a deeper fundamental stress.
Want to become smarter financially in 4 minutes or less? Sign up at fastest4.com to get insights and updates like this delivered to your inbox weekly.